They didn't attack in daylight. They waited for the weekend. They raised the margins, flooded the market with paper, painted the chart red, and walked away, confident the fear would do the rest. For 48 hours, the narrative was simple. Silver is done. The rally is over. The crash has begun. But when global markets reopened, something went wrong. The selling didn't continue. The panic didn't spread. Instead, the price snapped back with violence, not a bounce, a recoil. Losses erased in a single session, gaps filled as if they were never there. This wasn't recovery, it was rejection. The market looked at the crash attempt and said no, because this time, the selling didn't scare weak hands. It exposed something far more dangerous. There was nothing underneath the paper, no metal, no liquidity, no escape. What you just witnessed wasn't a rally. It was a trap closing in reverse, a moment where the hunters realized they'd stepped into their own snare. In this breakdown, we're not chasing predictions. We're examining the aftermath, why the crash failed, why the recovery was instant, and why for the first time in decades the system's strongest weapon misfired. This wasn't random, it was structural, and it changes everything. The market tried to break you. They waited, patiently watching, calculating. The margin calls, the paper shorts, the engineered panic. For 48 hours, red candles dominated the charts. Fear gripped the weak hands. Retail traders sold. Brokers smiled. The banks thought they had victory in hand. But they underestimated something fundamental, the bull's resilience. At sunrise, over London, the smoke cleared. The paper price had lied. The physical silver market had spoken, and it screamed truth. In a single session, the gap up erased the losses of the engineered sell-off. Not normal market behavior, not even close. This was a bear trap snapping shut, but not on retail traders. On the banks themselves, think about it. They know the stop-loss orders. They know the automatic sell triggers just below key psychological levels. $60, $62. The thresholds of panic, a small nudge, a scary headline, a margin hike, snap, retail sells, panic spreads, red candles terrify, shorts pile in. The banks expected obedient chaos, but instead the market absorbed it. Why? The composition has changed. Weak hands no longer dominate. Today, the holders are industrial giants, sovereign wealth funds, and family offices, entities with deep pockets. They are not speculators. They hedge supply chains. They secure wealth. When exchanges raised margin requirements, historically a nuclear weapon, they did not flinch. They wired the cash. They held the position. This failure of the margin nuke is profound. In 2011, a similar tactic crushed silver by 30% in days. Panic sold, speculators fled. But now the market's pain threshold is miscalculated. The banks misjudged the depth of diamond hands. And the result? A violent V-shaped recovery. Silver didn't bounce. It exploded. We are witnessing textbook market mechanics. The bear trap was a setup. Retail shorts were the fuel. But the recovery? It revealed the truth. The underlying physical market is far stronger than anyone expected. Weak markets bounce like a dead cat. Strong markets bounce like a Super Bowl. Silver just bounced like a Super Bowl. And the implications are terrifying for manipulators. When the market ignores engineered attacks, when bad news fails to shake it, it signals extreme underlying strength. This is the psychological pivot. Greed and fear exist, but now regret dominates. The trader who sold on Friday wakes to Monday's price action. Chest tightening, mind racing. I just financed the rocket. The bear trap has failed. The markets are awake. The physical holders are in control. The stage is set for the next leg higher. But one question remains. Can the banks regroup? Or is this the moment when centuries of market manipulation collide with an unstoppable physical force? Stay with me. In the next section, we reveal the London pivot, the moment the seller of last resort became the buyer of first. And when that happens, the game changes forever. For 40 years, London was the silent puppeteer of silver, the bullion banks, the LBMA, the seller of last resort. When the price rose too high, London poured supply into the market, calm, methodical, merciless. But that script just flipped. This morning, something unprecedented happened. Massive bid orders hit the tape, aggressive, unrelenting. London, the historic suppressor, became the buyer. Panic in reverse, but not out of greed, out of necessity. Because the float, the real available silver, was gone. Vanished, melted away. Let's clarify. Vault inventory is not float. Inventory sits in storage, often untouched, like a sleeping giant. Float is liquid, unallocated. The metal ready to move, to be leased, delivered, or sold. Historically, the float numbered hundreds of millions of ounces. Today, practically zero. Over the past 3 years, industrial giants and sovereign nations, India, China, and family offices, drained it bar by bar. They didn't touch ETFs. They bought physical, ready-to-move silver. And the banks, they miscalculated. Their leasing machine, the heart of London silver, depends on borrowed silver being returned. Refineries, electronics manufacturers, battery producers, they consume the silver, convert it into panels, devices, batteries. The metal vanishes. It cannot return. Lease rates spike, and the signal is terrifying. Shortage. Suddenly, the manipulators are trapped. Their vaults show silver on the books, but physically, empty. A hole in the balance sheet. And regulators are watching. The banks must scramble to buy physical bars, no matter the price. Every order is insensitive to $63, $65, $70. They need metal, desperately. This is the London pivot. The seller of last resort becomes the buyer of first. The consequences are immediate and violent. Price surges. Short sellers face losses they cannot cover. Retail traders stare at charts in disbelief. Sovereign and industrial buyers continue acquiring, indifferent to margin or paper price. The floor has shifted. Now, add one more layer, unallocated accounts. For decades, banks ran fractional silver, 100 ounces held for every 500 owed. Clients began demanding allocation, names on bars, serial numbers, private vaults. A bank run in slow motion. Each conversion removes ounces from the float. Each request forces the banks into the market. The pressure multiplies. The result? Explosive buying, structural scarcity, and a price trajectory no one can control. $61.50 becomes cheap. $65 looms as a psychological barrier, and every ounce purchased today is not speculation, it is necessity. London's pivot is more than a shift in orders. It is the moment the market told manipulators, your calculations were wrong. The float trap has snapped shut. The banks are chasing the market, and the path ahead is clear until the next crisis emerges. The stage is set. The bear trap is behind us. The London pivot has begun. But how high can this cascade go before the world takes notice? That, dear viewer, is the story for our next chapter. $65, that's the number, the line in the sand, the point where everything changes. For weeks, short sellers have parked millions of ounces here, betting silver would stall. But markets don't respect hope. They respect structure, liquidity, and physics. And right now, the physics are screaming the shorts are trapped. In the derivatives market, a massive concentration of call options sits at 65 $. December and January contracts alone represent millions of ounces. Every call sold by banks is a potential liability. Below $65, they pocket premiums, safe. Cross it, and the landscape flips. They must hedge. They must buy futures. And here's the catch. Buying pushes the price higher. Higher triggers more hedging. This is the self-reinforcing loop called a gamma squeeze. It's the same force behind GameStop in 2021, Tesla surges in 2023, but on a physical metal level. Imagine this. Every 1,000 ounces of call options sold forces banks to buy 400, 500 ounces of futures as the price approaches 65. As silver inches upward, the algorithms scream at triggering more purchases. Panic is coded. Mechanical, relentless. Price accelerates. Shorts scramble to cover, adding fuel. The air thins. Resistance evaporates. Add the London pivot from earlier. Banks in the UK are now buying physical bars to cover empty vaults. Asia continues to acquire aggressively. Industrial users are forced into the market. Supply is no longer a variable. They are competing for the same vanishing float. The countdown is clear. Every tick toward $65 is a silent timer. Seconds pass, algorithms react, hedges adjust. Every order increases velocity. Every passing hour adds pressure. The market is a spring stretched to its limit. One breach, and it snaps. Now consider the human element. Retail traders in New York and Chicago wake to headlines of Samsung battery shortages, China's import restrictions, and London's buying spree. Fear of missing out triggers another wave of demand. ETFs are forced to match inflows with metal purchases. It's a global domino. The FOMO crowd meets the institutional squeeze. The result is a perfect storm. Weak hands are crushed, overconfident bears are humiliated, banks face structural losses, industrial users secure their supply. And for the first time in decades, silver's trajectory is dictated by physical demand, not paper games. Here's the suspense. $65 is more than a price. It is the gamma wall, a psychological and mechanical battleground. Below it, shorts breathe. At it, panic. Above it, chaos. And as the U.S. markets open in a few hours, every algorithm, every trader, every sovereign fund has a role to play. The next 24 hours will define who controls the market. Will the shorts survive the breach? Or will the gamma squeeze trigger a cascade, sending silver surging past resistance, rewriting the rules of supply and demand forever? The market can't lie. Paper contracts can be printed endlessly, but physical metal has a heartbeat. And right now, the heartbeat is racing. For decades, bullion banks ran a hidden system, the silver leasing machine. They loaned ounces to refineries, industrial giants, even ETFs. The same ounce could be lent, returned, and relent, creating virtual supply, a mirage of liquidity. But mirages break. And this week, the illusion collapsed. Industrial users, electronics manufacturers, solar panel producers, even the EV giants are calling the banks. We need the metal now. The leased silver isn't coming back. It's consumed, transformed into batteries, circuits, and panels. The leasing system, which once lulled traders into complacency, is jammed. Banks expected the metal to rotate. It didn't. It vanished. Observational data confirms the alarm. London's unallocated accounts, the fractional system where clients hold claims, are under unprecedented stress. Reports indicate that in some accounts, up to 30% of holdings were suddenly requested for allocation. That's physical segregation of bars, metal that must be removed from the general pool. If a bank only holds 20% real metal for those claims, they're insolvent until they buy replacement bars, and the market knows it. Now, the race is on. Banks scramble into the spot market, not to speculate, but to cover structural holes. Prices don't matter. Whether silver's $63 or $66, the goal is to fill the vaults. This forced demand is explosive. Analysts like Dr. John Hathaway at Tocqueville Asset Management note, when physical demand collides with a depleted float, paper prices lose their authority. The result is violent upward pressure. Meanwhile, global physical buyers continue their campaign. India, for example, has been purchasing thousands of tons quietly over months. Samsung's battery news adds urgency. Every industrial order consumes ounces that can never return to leasing pools. Observationally, float estimates show near zero availability in dealer inventories, a stark contrast to the 800 million ounces on paper in London vaults. Most of that is illiquid, ETF-backed, or strategic stockpiles. The reality, available supply is gone. The stakes are cosmic. Imagine the silver leasing machine as the circulatory system of the market. When it clogs, pressure builds, heartbeats accelerate. Every institutional order, every ETF adjustment, every industrial request pumps the metal into fewer hands. Liquidity evaporates. Panic becomes mechanical. And here's the cliffhanger. With the float depleted, banks buying, industrial demand surging, and retail FOMO accelerating, silver isn't just moving, it's trapped in a pressure cooker. One breach, one cascading order, and the market could explode beyond $65 an ounce. The leasing machine that controlled decades of manipulation has jammed, and no one knows how high the metal will go before it finds a new equilibrium. Fear and greed drive markets, but right now another force dominates: regret. The Friday drop, the bear trap, it wasn't just a test of resolve, it was a psychological pivot. Those who sold in panic are now trapped in hindsight, watching silver soar past their exit points. Their regret fuels the next wave of buying. Institutional players, the deep-pocketed giants, are feeling it first. Hedge funds, family offices, sovereign wealth funds, they are watching the depleted London float, the frozen leasing machine, and the relentless industrial demand. The signal is clear. Physical silver is scarce, and anyone without it risks falling behind. Here's the turning point. FOMO, the fear of missing out, has gone institutional. Unlike retail traders, these entities move in massive blocks. When a sovereign wealth fund decides to convert unallocated silver to allocated, it doesn't just remove a few ounces. It withdraws thousands, sometimes millions of ounces, forcing banks to chase metal into a market that barely exists. Bloomberg reported earlier this year that Asian industrial demand alone consumed over 1,500 tons of float in the last 12 months. That's physical metal that can't be recreated overnight. The psychological shift is profound. For 40 years, the bullion banks set the narrative. London was the suppression capital. The big banks sold when prices climbed, and the world followed. But now, the script has flipped. Banks are no longer controlling the game. They're reacting to it. Their panic buying is confirmation of scarcity. The very institutions that once created downward pressure are now amplifying upward momentum. Consider the dynamics. The larger the buying, the more pressure on paper shorts. The market becomes a self-reinforcing loop. Every forced buy, every allocation request, every industrial order turns the tide. As Dr. Jeffrey Christian of CPM Group notes, when the physical market dominates, paper derivatives become almost irrelevant. The metal sets the price, not the contracts. Retail investors feel the ripple. When they see institutions piling in, fear of missing out spreads like wildfire. Observational data from ETF flows shows a surge in Asia and North America. Silver-backed ETFs reported inflows of over 30 million ounces in the past week alone, far above the historical average. Momentum traders notice the spike. The market psychology shifts. Scarcity breeds urgency, and urgency breeds price spikes. The countdown is relentless. The next ETF settlement, the next London auction, the next industrial shipment, they all act as triggers in a tightly wound system. Every second counts. And in this crucible of scarcity and regret, the market is primed for explosive moves. As FOMO spreads institutionally and retail joins the wave, the battle line is drawn at $65. The gamma wall, the depleted float, the forced allocations, they all converge. Will the short sellers withstand this pressure? Or will the market erupt beyond any resistance, rewriting the rules of silver trading? Only the opening bell in the next 24 hours will reveal the answer. The market is tense. $65 is not just a number. It's a psychological kill zone, a barrier where short sellers tremble, a line where paper and reality collide. And at this exact threshold, a hidden force waits, the gamma wall. Gamma, delta, hedging. Words that sound technical, but their consequences are explosive. When hedge funds and market makers sell call options, they promise to deliver silver at a set price. $65 is that strike price. Below it, they breathe easy. Above it, they are forced to buy the underlying asset, not gradually, but in cascading increments. Imagine it, a wall of options, millions of ounces of silver. As the price inches towards $65, delta hedging kicks in. Algorithms programmed to limit exposure, buy futures contracts to cover their risk. That buying pushes the price higher, triggering more hedges, which forces more buying. It's a self-feeding loop, a pressure cooker ready to explode. Historical precedent exists. Remember GameStop in 2021, Tesla? Gamma squeezes aren't theory, they are violent reality. Dr. Campbell Harvey, a leading finance professor at Duke University, explains, gamma squeezes amplify momentum. They can turn minor moves into parabolic spikes because the market makers are buying to hedge, not to speculate. Now, picture this in the silver market. Physical scarcity, institutional FOMO, and depleted float converge with gamma mechanics. The result? A potential short squeeze of historic proportions. The shorts are trapped. The Friday bear trap was a warning. Now the gamma wall is a cage. Every forced buy compounds losses for those who bet against the metal. Margin calls loom. Panicked orders hit the tape. The price reacts violently, moving in $1 to $2 increments per second. Volume spikes, liquidity evaporates, and the market becomes a battlefield. This is not a gentle rally. It is mechanical, unstoppable, and ruthless. Every incremental move toward $65 increases the pressure. Every hesitant short becomes a forced buyer. And with the float already depleted in London, there's no buffer. The physical market, the ETFs, the industrial buyers, they all converge. There is nowhere for shorts to hide. Countdown. The US market opens. The next 12 hours will determine the trajectory. Will the gamma wall crack? Will delta hedging ignite a chain reaction, sending silver vertical? Or will the shorts find relief? Observational data from CME shows open interest at the $65 strike exceeding 50 million ounces. That's a tsunami of potential buying locked in the derivatives. If silver breaches $65 with volume, the market mechanics guarantee one thing: short sellers will be hunted mercilessly. The river of paper metal will collide with the scarcity of physical silver, and the landscape of the market will change forever. The stage is set. The countdown has begun. The rocket is fueled. The question is, who will survive the squeeze and who will be swept away? The market just whispered its secrets. Did you hear it? $65 isn't just a number, it's a battlefield. And the forces shaping silver are moving faster than most can see. If you stayed until now, you're not just a spectator, you're part of the story. But knowledge is only power when it's acted on. Subscribe now to get every update, every shift, every twist in this historic rally. Hit the bell so you never miss the next move, because silver waits for no one. Comment below, did you see the gamma wall coming? Are you ready for the next squeeze? Markets are cruel. They reward patience, they punish hesitation, but the tide is turning. The rocket has cleared the tower. Don't get left on the launch pad. Your move is simple. Stay informed, stay alert, and hold your position. The shorts are trapped. The float is gone. The squeeze is real. Remember, history doesn't wait. neither should you.